Hi, good morning, guys. Welcome to this week's morning webinar. So for today's agenda, we have two things on the table. First off, I will touch on First Read. They just did their first acquisition last week. So this is a much awaited acquisition because for First Read, before before this year, you see that every single year they've been doing acquisitions, but this year they've been pretty quiet. So finally this year they've announced something. So we'll talk about that in a short while, and then after that, Peter will go on to talk about hospitality. So we move on to First Read first. Last week, they announced this acquisition of Siloam Hospitals, Kupang, and the adjacent shopping mall called Lippo Plaza Kupang. This is a very small shopping mall, and then the cost of these two buildings is 70 million, around a 6% discount to the average of two independent valuations that were done on the buildings. And then once they are acquired by First REIT, they'll be leased out on master lease terms, and then rental income will be about 6.89 million Sing per annum. And then this will be, if you look at the last line, this will be pegged to the Singapore CPI every year. So every year the increment only comes in after year three, and the increment will be pegged to two times the Singapore CPI, which is subject to a minimum of zero. So if CPI is negative, you won't get a negative reversion. You will just get flat reversion. But if CPI is 4%, you also wouldn't get 2 times 4%, 8%. You wouldn't get 8%. You'll get maximum 2%. So your downside is limited, but your upside is limited as well. And so the yield on the cost, if you're getting 6.89 million of rental in a year, your yield on the cost is about 9.8%. Which is pretty good. It's pretty comparable to what they have done in previous years. Previous acquisitions from 2010 to 2014, yield on cost were all around 9.9% to 10.9%. So this is pretty in line. And then the master lease is for a long, very stable 15 years. After the 15 years, there's another option to renew for a further 15. Financing wise, most of the cost consideration will be paid via cash, either internal cash or debt. And then there's another 15 million that will be paid via issue of consideration units. So these consideration units will be issued to the seller. And the good thing about this is that these units are issued at a price of $1.30. If you consider that versus the current price of about 119, it sounds pretty silly. But what we understand from management is that these negotiations have been going on for a while already. And then at that point when they were actually negotiating for the sale and the purchase, the price then was around 130, which is why the agreement then was to take the units at issue price of 130. So key highlights for this acquisition is that if you look at all these terms, you will find similarities, a lot of similarities in these terms versus the master leases that First REIT have now. In terms of the length of the master lease, 15 years, the pegging of the reversions to Singapore CPI, you find that a lot of the terms are similar. MPIU is also pretty high at 9.8, but the only big difference I would have to point out is that the land lease for the acquisition is actually only for 25 years starting from last year. So this compares with previous acquisitions that were all on they are actually on this title in Indonesia. It's called the HGB title. These titles are as good as freehold because these titles are initially granted for a 30-year period, but then after the 30 years, you renew them for 20 years, but you only actually pay a nominal fee. And then after the 20 years, so 30 plus 20, after the 20, you get a new HGB title again. So previous acquisitions all on HGB, which were as good as freehold, but then this time round it's only a shorter lease of 25 years. So we have talked about First Street and their sponsor in our previous report last month. So we talked about the possibility of a slowdown in the injection of assets into first REIT because the Indonesian government is trying to build a more conducive, a more accommodating um, environment in Indonesia for REIT listing. Because they now currently they have taxes like capital gains tax over there, so they're trying to tweak all this and then try to incentivize people or developers to lease REITs over there. This morning you saw an article on Cinema's Land as well, who is considering a REIT listing in Indonesia as well. So with that being said, Lipo Group with their hospitals and their developed properties, they actually have an additional outlet to recycle capital. So they need not just pass it on to first REIT. They could actually bundle them into a REIT and then list them in Indonesia. So there is this possibility there, but we have no idea how long these measures are going to take to pan out because the minister saying this is one thing, but actually implementing it could take some time as well. So in view of the fact that this acquisition pipeline could slow, we actually adjusted our terminal growth rate downwards. We used to use a 1.5%, now we're going to use 1%. So with that lowering of the growth rate, we actually have a lower target price of 138 now versus the previous of 149. But notwithstanding the lower target price, we actually upgrade our call from accumulate to buy on the back of the recent price correction. Current price is doing about 119. So with that, I'll pass on to Peter to talk about the hospitality sector.
Morning, everyone. This is another update on the hospitality sector. Well, 3Q numbers came in shortly after the report that we have published previously. So on a year-on-year basis, it went up 5.8%, and this is the first quarter of growth after 7 consecutive quarters of decline. And this number came in not as a surprise because based on the scenario analysis that we have done previously in our report in October, we concluded that likelihood of a positive year-on-year growth was relatively high, and it has been the case. So, more importantly, one of the scenarios that we have tested specifically was a 3% year-on-year growth in visitor arrivals in September 2015. And this scenario has materialized, showing a 5.8% year-on-year growth. Next, just in September itself, we saw a single-digit growth in visitor arrivals, and this is not only the fifth consecutive month of growth, but we also note that it was a month-of-month decline from August. So in the previous report, we said that we also highlighted that this expectation of continuation of growth momentum in September, but nonetheless, we expected a decline due to seasonality. For these 3Q numbers, we expected a 5 point, no, sorry, let me say that again. For the third quarter, visitor arrivals came in 5.8% higher. And can I just remind everyone that the long-term CAGR, or the compound annual growth rate, for the last 10 years between 2004 and 2014 was 6.1%. So coming at 5.8%, it's making things look more optimistic now. And again, this visitor arrival growth was of no surprises because they were mainly driven by Chinese and Indian visitors, or I should say that the main part of it came from Chinese visitors. If I just bring everyone's attention to the table here, Chinese visitors grew 44.1% year on year, or solid 200,000 visitors just in the quarter alone. And there are actually more good news to come because apart from the growth in the Chinese and Indian visitors, visitors from Indonesia, Malaysia, and Australia, although they are still declining year on year, but we see these numbers, the decline starting to taper off already. So if you look at Indonesia now, just look at the orange and the white squares. The positioning of them between 3Q15 and 4 and 3Q14, these boxes, the positioning is really it gets a little higher, showing that the decline is wearing off. Next, we perform a scenario analysis this time around to try to predict the um, the visitor arrivals in the fourth quarter of 2015. So even at a modest 1% year-on-year growth in the fourth quarter, this will still meet the Singapore Tourism Board's projection of 0%, the lower bound of 0%. For the STB, they have actually projected that visitor arrivals will grow between 0 to 3% 2015. So if, and again, if 4Q15 is to grow at 1%, this will make the whole year's visitor arrival break even. And now looking at the current situation now, we think that 5% year-on-year growth in the fourth quarter is a reasonable expectation. And if this were to materialize, we would see a 1% growth in visitor arrivals in the full year of 2015. Okay, this is actually the same slide that we have published in the previous report. So I'll not go through it again, but nonetheless, it was just put here to show you that the cluster of events all the way to the end of the year would be able to leave the tourist arrivals. Now, last but not least, these are the hotel statistics. And consistent with the higher visitor arrivals into Singapore, we see that occupancy rate is at the all-time high, or I would say that it's at the 8-year high, coming at 88.5%. Even though there was weaker corporate travel, there was a strong SGD, as well as the hazy weather conditions that is currently still ongoing. But we also note that room rates have been weak, and this is the sixth consecutive quarter of year-on-year decline. So similarly, as what we have said before, we think that the high SGD and on top of the high SGD, as well as hoteliers have been slashing prices, we think that these budget-conscious travelers have been switching their selection of the places for them to stay. That means that they've been going towards the lower end segment as compared to luxury and high end segments. Therefore, room rates were affected from such behaviors. And as a result of the lower room rates, we see RevPAR, which is a function of occupancy rate multiplied by room rate, came down on both the third quarter and the 9-month basis. On the third quarter, we see RevPAR on $221.80, and for a 9-month, it was $207.30, down from around $220.60 in the same 9th month last year. Okay, this is a roundup of the quarterly results of the hospitality REIT subsector. And it's actually quite mixed. So we'll start off by giving a summary to everyone. So for Ascott and OE Hospitality Trust, you registered a double-digit revenue growth. But for Ascott especially, for Ascott and OE Hospitality Trust, the reason why they had a higher gross revenue is because of the acquisitions that they have done. And now when we look at Ascott, revenue grew, NPI grew as well, or NPI, or in the sense net property income grew, but on the distributable income and DPU level, things fell. This was because of a higher financing cost that they incurred. So for OE Hospitality Trust, this was a clear-cut growth for them. Everything grew across the board. Then as we look up the list, Ascendus Hospitality Trust, gross revenue came down mainly because of foreign exchange losses. So, but on the other hand, distributable income and DPU grew due to a divestment that they have made. during the same during the same period of time. And there's nothing much to talk about Fraser's Hospitality because it was just IPO last year. So as for CDL Hospitality Trust, we see some growth on revenue level, but it's not sustainable on the distributable income and DPU level because of certain amount of working capital or 10% working capital that it retained for AEI or renovations purposes. Lastly, for FICE Hospitality Trust, it was a decline across the board due to stiffer competition, as well as some rooms that they have taken offline for AEI works. Now, finally, these are the performance measures of the hospitality REIT subsector. And this graphical representation depicts the gearing level, weighted average debt to maturity, the weighted average cost of debt, and finally the interest coverage of the 6 hospitality trusts in Singapore. So for that, we've come to the end of our presentation. Feel free to ask us any questions you may have.
Hi Maria, your question on okay, what is the difference between our calls when we say accumulate or when we say buy or when we say reduce or when we say sell? What is the difference? Okay, we have a rating table at the end of our report, and then over there we have stated that for accumulate, that is for an upside of 5% to 20%. And when we say buys, that will mean that the upsides from current price will be more than 20%. And all these upsides are factoring in dividend yields. So that is the difference between accumulates and buys.
Hi, there's a question on the Sanders Hospitality Trust. So, why is it that they're able to distribute uh, more distributions, or why is it that its net income available distribution, I mean, to unit holders is higher despite the lower revenue? That's because that they've made a divestment during the same point of time, meaning that it's sold off a property. So when sell of property, it's not recorded on the revenue level.
Helen's email address. I'll just read out how to spell it. I can't find it. Because he brought the IPO deal, right? But I don't have his name card.
I got a question on CDL. So this was referring to the interest coverage. Well, 6.6 doesn't mean that this is the interest rate they are paying. Actually, what you should be looking at is the weighted average cost of debt, or WACD. Essentially, the trust is paying 2.6% interest for their loans. Or how you should interpret interest coverage is the amount of the number of times which net property income can cover the interest paid or interest expense.
Hi guys. Question on first read again. First, the question is first read. Possibility of it delisting from Singapore and moving to Indonesia. So we have actually issued a report last month. There is a hyperlink to that October report in our latest report this morning. So that report we came out actually is right after when the news actually reported what the Lipo CEO has said about this possible possibility of the shift in the listing from Singapore to Indonesia. So we have listed a few hurdles and a few like concerns which we think are factors that we that actually cause us or lead us to think that the transfer is not that likely because of a few things. Firstly, the rental contracts for the hospitals, they are mostly they are mostly negotiated in Sing dollar terms, and this actually reduces the forex exposure for investors in First REIT. And why are they structured in such a way is because at the IPO during the IPO the a lot of the contracts, the lessees, are actually the parent itself. So the parent offers to pay First REIT in Sing dollars to help them mitigate the forex exposure. So that is for the benefit of investors. So now that you have all your rentals locked up in Sing dollars for 15 years, you can move it back to Indonesia. Then there's a whole new set of risks for Indonesian investors. And then not forgetting if you move it back to Indonesia, there are other concerns as well. Your valuations in rupiah terms, then your borrowings will have to be in the same country as well. not only do you face higher borrowing costs, your REIT market over there is much less mature as well. For Singapore, we have grown tremendously since our first REIT listing in 2002, I think, for Capital Mall Trust. So right now, our REIT size is in excess of 61 billion USD. So we definitely have a much more mature REIT market, and it's easier to attract institutional investors over here. So if you move it back to Indonesia, the market there is really very much in infancy stage. They only have one REIT listing there so far, and then so because of these reasons, we feel like the transfer may not be very likely. And then lastly, also the minister has mentioned that these are measures that they intend to undertake, but then actual implementation may take some time as well. So if you're interested in a more detailed write-up, you can refer to our October report. But primarily, these are the few reasons why we think that the transfer would not be a very likely scenario.
Hi, this is Peter again. Sorry, I make a mistake just now about interest coverage. So just now I said that is using MPI or net property income divided by total interest expense, but that's not correct because the correct way of doing it is through operating earnings or EBIT. So I hope that I've clarified.
Hi, Devon here again. Okay, Xiangliang, your question on first read again. I fully agree with what you said about the comment about for Indonesian investors, right? If they were to be exposed to Sing dollar, it may not be that bad. You know, if you look at it historically, right, it may not be that bad. But then the thing about it is there are two ways to look at it. So when people buy REITs, a lot of times they want stable income, foreseeable income. So it may not be that bad if you look on hindsight. But then the thing is, you are exposed to another further set of risks, the forex exposure. So you if you are receiving in Sing dollars and your assets are in rupiah, you you are essentially taking another bet. So on top of taking a bullish bet on the Indonesian healthcare system, right? That's number one. You're also taking a bet on Sing dollars versus the Indonesian rupiah, the exchange rate. So which may not be what a lot of people want because essentially you're taking a double bet. So there can be two ways to look at it. It's the same for like when we covered Capital Land Retail China Trust. They initially don't hedge the forex exposure because of timing issues. And then feedback was that a lot of investors they actually wanted exposure to RMB versus Sing dollars. So it's actually is really um, different. There are different ways to look at it. Some people want stability, but some people want that kind of exposure in the forex, the forex currencies. So in not having in not having different currencies in terms of your assets and your rental incomes, you actually are mitigating your forex exposures. And then for Lipomore, I guess the concerns that we raised about the implementation risks in terms of the timeline of implementation, and as well as the concerns of higher borrowing costs and country risk, the more stable, the more mature REIT market here. These concerns will be similar to Lipo Mall, but then, yeah, the rentals, as you pointed out, will not be an issue for them then. And then another question on the transfer, how would they do a transfer? We mentioned that in our report as well, that if they were to do a transfer, that would involve a delisting and a general offer. And because of the fact that First Street has very fragmented shareholding structure, the top the top shareholder is actually the parent, which is about 27%. Then onward from that, you see that all the shareholders, the next one should be only around 2 or 3% if I remember correctly. And then further down the list, you see all very, very fragmented structures. So if you were to do a general takeover offer, then that would have to involve putting forward an attractive takeover price at a premium to current price. Hi guys. So I see no further questions flowing in, and so with that, we will bring an end to our webinar here. Thanks for tuning in and hope to see you guys again next week. Okay, he's not already. You see his name there. He has left already. You can privately email him if you want to. Can also.